the price is lying because the spread is telling the truth. And that's why gold and silver are suddenly moving like one asset. Not because the world collectively got bullish at the same time, not because a headline flashed and everyone agreed. This is pressure. This is positioning. This is the kind of synchronized move that usually shows up when the plumbing is tighter than the commentary. And if you understand the plumbing, you stop reacting to the noise and you start anticipating the next forced decision. Next week, not next year. Because if one specific level breaks, the math changes. Here's the conflict. Most people are watching spot prices like it's a scoreboard. Meanwhile, the serious signal is in how the market is pricing time, collateral, and immediacy. Gold and silver don't just move together by accident. When they lockstep, it messes often the market, admitting a single driver is dominating multiple channels at once, funding conditions, hedging flows, scarcity signals, and the quiet fear that the paper claim and the physical reality can drift apart at exactly the worst moment. And that's where the real pressure starts. Because when two different metals with two different demand profiles begin to behave like one risk, it tells you the driver is bigger than jewelry demand, bigger than one factory order, bigger than one rumor. It's systemic. It's structural. And it's happening right now. You can feel it in the speed of the tape. Gold has been orbiting the mid-4,000s per ounce range in mid-January 2026, and silver has been trading around the high 80s to low 90s zone. Those numbers matter less than what they represent, a market that repricing purchasing power and repricing collateral at the same time. Speed matters, because speed is what forces participants to do things they don't want to do. Speed is what turns, I'll wait for a dip, into, I have to cover today. Speed is what turns I can roll the position into I am getting margin called. But that's not the part that matters. The next detail is what flips the whole setup. This isn't just a rally. It's a synchronized stress test across the curve, across leverage, across inventory assumptions, and the market is screaming it through the way gold and silver are moving together, not just up or down. Together, in sync, like they're being pulled by one magnet. So what is that magnet? Start with the simplest truth. Gold is monetary and psychological first, industrial second. Silver is monetary and industrial at the same time, and that makes it fragile. Silver's demand can surge when the monetary crowd shows up, but its supply can T-flex quickly, because a lot of silver is mined as a byproduct of other metals. You can just turn on silver production because silver isn't always the main product. That means when silver catches a monetary bid at the same time, industrial demand remains stubborn, you get a market that can move like a trapped spring. Now layer in the macro. When the market senses policy credibility risk, when it senses that real purchasing power is being diluted faster than official narratives admit, metals stop trading like ordinary commodities and start trading like insurance. Insurance doesn't need perfection, it just needs fear of the tail. And when insurance is in demand, gold gets the first, cleanest bid. Central banks, long-only allocators, sovereign behavior, conservative capital. Silver then becomes the turbocharger because it's smaller, thinner, more volatile, and easier to push around with marginal flows. That's why silver often looks like it's late, and then it suddenly isn't. And that S where the real trap forms, people who dismiss silver as too volatile end up watching it do the most violent catch-up move when gold stays firm and liquidity thins. But again, don't get hypnotized by the story. Watch the mechanism, because in markets, mechanism beats narrative. Here's the hidden detail that reframes the whole thing. When volatility in metals spikes, exchanges and clearinghouses don't sit still. They manage risk. They change collateral demands. And recently, the CME announced changes to how it calculates margins for precious metals futures, shifting toward a percentage of notional approach, rather than a fixed dollar amount in a volatile environment. That sounds boring until you realize what it does. It changes who can stay in the trade. It changes who is forced to reduce. It changes how easy it is to carry leverage through a fast move. And when margin logic changes in a fast market, you get forced behavior. Forced behavior is everything. Because forced behavior is what creates those, why is it moving like this? Odd candles. Forced behavior is why gold and silver can move together even when the daily headlines don't T-align. Think of it like this. If the cost to hold a position rises as price rises, then the market has built-in friction against leveraged longs. But if the risk is concentrated in one side, if shorts are trapped and deliverability is questioned, then higher margin can also force shorts to cover faster because carrying the risk becomes expensive. Either way, leverage gets squeezed. And when leverage gets squeezed, the market stops being a gentle auction. It becomes a cascade of risk controls. But here's the twist. In precious metals, you're never just trading price. You're trading time. You're trading the curve. You're trading the difference between now metal and later metal. And that's where the spread tells the truth. In a normal world, the futures curve often prices storage, insurance, and financing, the cost of carry. That can create a gentle contango, where deferred contracts are higher than the nearby. But when the market is short of immediacy, when it needs metal now, you can see backwardation, or more commonly, tight nearby spreads, where the front contract refuses to cheapen relative to later months. That's the market rationing metal. That's the market saying the convenience yield is real and someone is paying it. And once you see tightness in the curve, you stop arguing about whether this is just a rally, because tightness is a constraint. It forces behavior. It forces producers, refiners, banks, and arbitrageurs to respond. And that's where the paper versus physical tension becomes visible without anyone needing to accuse anyone of anything. Incentives do the work. Here's how it plays out. If futures are tight in the front, the short side that needs to deliver has fewer cheap options. If inventories that are deliverable are not as abundant as people assumed, or if they re-abundant, but not in the right form, the right location, the right bars, then the short has a problem. They can buy back the short, they can roll it forward and pay the spread, or they can try to source metal and face premiums, logistics, and time. None of those options are free. And when none of the options are free, price discovery becomes a negotiation under stress. That stress can show up first in spreads, then in volatility, then in synchronized moves. And that, yes, exactly what gold and silver moving together is signaling, the constraints are being priced, not just the sentiment. Now add the institutional layer. Gold has a bid that doesn't care about your opinion. Central banks have been a persistent presence in gold markets in recent years, and that kind of bid is sticky, it's slow. It doesn't panic sell because of a one-day candle. That's why gold can stay firm even when risk assets wobble. And when gold stays firm, silver becomes the leveraged expression for anyone who wants more torque to the same macro driver. Funds rotate into the higher beta cousin. Traders chase the volatility because it offers opportunity. Retail shows up because the nominal price looks cheaper. Industrial users, meanwhile, have their own timeline. They don't buy because it's fun. They buy because they have to build. That mix creates a market that can go from orderly to chaotic quickly. But that's not the part that matters. The part that matters is the reflexivity engine that kicks in when options positioning and dealer hedging collide with a thin market. Let's translate that without turning it into a textbook. Options have deltas. Dealers who sell options hedge those deltas. When a market rises toward key strikes where there's heavy call interest, hedging can require dealers to buy the underlying to stay neutral. That buying pushes price up, which increases delta, which forces more buying. That's gamma. It's not a conspiracy. It's mechanical. It's risk management under a model. And it becomes explosive in a thin market because each incremental buy moves price more than usual. The same concept works in reverse on the downside. If price drops through put-heavy strikes, hedging can force selling. This is why certain levels feel magnetic. This is why price can look inevitable in the moment and then shockingly reverse when positioning flips. And that's why you need a two-scenario lens, not a one-story fantasy. We'll get to that. But first, lock in the proof stack, because you don't want a single argument. You want 5 layers. Layer 1. Synchronized movement itself is a signal of a dominant driver. When gold and silver move together, especially with speed, it suggests macro and liquidity are in the driver's seat. Layer 2, the curve. Tight front spreads and unusual term structure behavior are the market's early warning system. Layer 3, collateral and margin behavior. When exchanges adjust margin logic during volatility, you're being told risk is high and leverage is being challenged. Layer 4, supply chain reality. Silver's byproduct nature and refining logistics lead times make supply less responsive than people think. Layer 5, institutional and behavioral flow. Gold's steady conservative bid plus silver S8 gas high beta reflexivity creates a cocktail that can move as one when the macro trigger is pressed and the market has pressed it. But here's the uncomfortable truth. Synchronized moves can also happen on the way down. Correlation rises when stress rises. In risk-off liquidation, everything that can be sold gets sold. That S, why you can T just cheer, they were moving together, and assume it S bullish. You have to ask, what kind of together is it? Is it controlled with pullbacks that hold key levels and spreads staying firm? Or is it frantic with liquidity gaps, violent intraday reversals, and spreads loosening as fear forces sales? That's the difference between a trend signal and noise. Trend is structure. Noise is emotion. And in a fast market, noise is loud. The market will try to manipulate you emotionally, not because the market is a person, but because your brain is wired to panic at speed and to chase at peaks. That's the viewer psychology shield you need if you want to survive this. The first trick volatility uses is the fake breakdown. Price slices below an obvious level, social media screams, "It's over," and then price snaps back because the move was a stop hunt in a thin liquidity pocket. The second trick is the fake breakout. Price rips above a round number, everyone feels late, everyone piles in, and then the market mean reverts because the breakout was driven by hedging flow that exhausts. The third trick is the narrative whiplash. One day it's rates will stay high forever, the next day it's cuts are coming, and the metals move either way because the real driver was positioning, not the headline. If you don't have a framework, you become liquidity for someone who does. But that's not the part that matters. The next detail flips the whole setup into a near-term roadmap. The calendar. The calendar is the catalyst because it compresses decisions. Options expirations, contract roll windows, delivery periods, month-end and quarter-end positioning, all of it forces managers to act within a narrow band of days. In mid-January, liquidity can also get weird around holiday weeks and around the first real positioning month after year-end resets. When liquidity thins, gaps get bigger. When gaps get bigger, risk managers get louder. When risk managers get louder, positioning gets forced. And when positioning gets forced, gold and silver can move together in violent bursts because everyone is reacting to the same constraint. Don't blow up on margin. Don't be short into a squeeze. Don't be unhedged into a gap. That's why now is not just a story, it's a schedule, it's a deadline, it's a window. Now let's talk levels, not as prophecy, but as behavior triggers. You don't need a magic target. You need a line that changes what participants do. For gold, the mid-$4,600 area has been an important battlefield recently. A clean, sustained hold above the mid-4,500s keeps the structure constructive because it says the market is absorbing profit-taking without breaking the trend. A dip that holds that zone and then reclaims the prior day, S highs, is the kind of retest that professionals respect. On the upside, pushing and holding above the high 4,600s into the $4,700 region is where reflexivity can accelerate because it forces late hedges and compresses time for shorts to manage risk. For silver, the high 80s to low 90s zone has been the arena. The $88-$90 region acts like a psychological and mechanical pivot because it's where a lot of short-term positioning and option strikes cluster in a fast tape. If silver holds that zone on pullbacks, the market is telling you dips are being bought and supply is not easily offered. If silver loses cleanly and stays below, especially with spreads loosening, then the market is telling you the move was more leverage than scarcity. Above the $95 area is a pressure point because it S where momentum traders often add and where dealer hedging can intensify if calls stack. And then you have the big obvious psychological magnet, $100. Round numbers matter because humans trade them and because risk limits and option strikes love them. If $100 gets tagged and held, you're not in a normal drift. You're in a squeeze narrative that can feed itself. But that's not the part that matters. The part that matters is what confirms and what invalidates. Because that S, how you keep trust with yourself. Confirmation isn't, it went up today. Confirmation is structure and behavior. Here is what confirms the thesis in the next week or two. Gold holds key support on pullbacks, while silver refuses to give back the bulk of its gains. The gold-silver relationship tightens rather than blowing out. The curve stays tight in the front rather than relaxing. Volatility stays elevated but not chaotic, meaning you see big candles, but they resolve in the direction of the trend more often than not. Another confirmation, you see buy the dip behavior in the tape. Fast recoveries after sharp drops, closes that matter, not just intraday spikes. And you see the opposite side, the skeptics, getting progressively more uncomfortable. The market will telegraph that through failed breakdowns and through sudden upside bursts that look like forced buying. Invalidation is also clear if you're willing to look. If gold breaks below the mid-4,500s region and can't reclaim it, if silver loses the high 80s pivot and starts living under it, if the curve loosens, meaning near contracts stop being special, then the scarcity and constraint angle weakens. If you see a sharp spike in volatility followed by a dead market with weak bounces, that suggests the move was primarily leveraged positioning that got flushed, not a persistent structural bid. And if the macro driver shifts, say the dollar rips higher and real yields surge in a way the market believes, metals can get hit even if the longer-term story still exists. That's why risk framing matters. Price can whip around violently even if the thesis is correct. A violent pullback does not automatically mean the story is dead, but a structural break in key levels and in spreads does. That's the difference between noise and trend. Now run the two-scenario lens because this is where retail investors usually lose the plot. Scenario 1 is the controlled pullback and retest. This is the professional scenario. Price pulls back hard enough to scare late buyers, but not hard enough to break the structure. Gold dips toward support, finds bids, and grinds back. Silver snaps down, shakes out weak hands, then reclaims levels quickly because the underlying bid is still there. In this scenario, the best signal is not the low of the day. It's the close. It's whether the market can close back above key pivots after a flush. It's whether the next day follows through instead of collapsing. It asks whether spreads remain tight and whether any stress symptoms remain present. Tight front spreads, steady physical interest, cautious risk messaging. Scenario 2 is the continuation squeeze and gap risk. This is the thin liquidity, forced buying scenario. Dips don't fill, pullbacks are shallow. Price accelerates into strikes where options day hedging adds fuel. The market starts moving in jumps rather than steps. And that S where people get emotionally manipulated the most because the tape looks like free money until it doesn't T. In this scenario, the risk is not that you miss the move. The risk is that you chase it at the worst moment and then get whipped out by a brutal reversal. This is where you need your psychology shield. You need rules. You need position sizing that lets you survive a 5 to 10% intraday swing without making a panic decision. You need to separate, I believe, the trend on which I am over-levered at the peak, because those are different. And the market punishes confusion. But what about the skeptics? The people who say, this is just a bubble, this is just hype, this is just manipulation? Here's the finance literate answer. Markets can be pushed when liquidity is thin and positioning is crowded. That doesn't require secret meetings. It requires incentives. It requires risk limits. It requires the fact that some participants are forced to transact at the worst times. When silver runs and margin rules tighten, someone somewhere is reducing exposure. When gold holds firm while headlines wobble, someone somewhere is accumulating quietly. When spreads tighten, someone somewhere is paying for immediacy. Those are facts of behavior. And that S, why gold and silver moving together, is powerful. It suggests multiple participant classes are responding to the same underlying constraint. And that constraint is usually a mix of macro insurance demand and market structure tightness. Now watch the street symptom clues. You'll hear chatter about premiums. You'll hear about delays. You'll hear about inventory questions, deliverable versus non-deliverable, exchange registered versus off exchange, available versus available at a price. You'll see how quickly dips get bought. You'll watch whether sellers show up with size or whether the offer keeps evaporating. You'll watch whether the market gets heavy into the close or strong into the close, because closes matter to funds, to option hedges, to risk committees. That's where the real pressure starts, because closing prices determine what people have to report and how much margin they must post. And when reporting and margin collide, behavior becomes less optional. The market also tries to distract you with the wrong comparisons. People will obsess over a single influencer prediction, or a single sensational target, or a single dramatic story about paper breaking. Ignore the cartoon, watch the curve, watch the collateral, watch the relationship between gold and silver, watch whether the gold-silver ratio compresses as silver catches up. A compressing ratio can be a sign that silver is expressing the same monetary stress with higher beta. But if the ratio starts widening violently because silver collapses while gold holds, that suggests the silver move was more speculative and more fragile. Both are tradable realities, but they mean different things, and they demand different risk posture. Now let's ground this in practical what to watch next week items, because this is where trust is built. First, watch the key levels into the close, not at noon. Gold holding above the mid 4,500 zone on daily closes matters more than any intraday spike. Silver holding the high 80s to low 90s pivot on daily closes matters more than any headline. Second, watch volatility behavior. Elevated volatility with constructive closes suggests a trend with stress, not a trend that's dying. Exploding volatility with ugly closes and weak bounces suggests leverage being unwound. Third, watch the curve. If near-month tightness persists, that supports the constraint thesis. If it relaxes quickly, it suggests the market's urgency is fading. Fourth, watch the calendar catalysts, options-related flows, and the rhythm of roll windows. If you see sharp moves around major strikes and then stabilization, that's hedging flow. If you see sharp moves that refuse to revert and keep climbing, that's reflexivity plus scarcity. Fifth, watch macro triggers that can flip the tape quickly. Dollar surges, abrupt rate repricing, sudden risk-off shocks. You don't have to predict them, but you have to respect them. Because even if the long-term thesis is intact, short-term tape can still punish you. That's not weakness, that's reality. Now let's be explicit about the credibility guardrails. Nothing here is a guaranteed outcome. Metals can do violent things in both directions. Markets can front-run events. They can exhaust. They can trap both bulls and bears. You can be directionally right and still lose money if you size wrong, if you chase, if you can't tolerate volatility. The goal is not to win a debate. The goal is to read the mechanism and manage risk. And right now, the mechanism is flashing. Gold and silver moving together is not cute. It is a powerful signal because it implies the market is repricing the same underlying fear across two different instruments, while the microstructure, spreads, margin options, adds gasoline. That's why this move can persist longer than skeptics expect, and why pullbacks can be sharper than optimists can tolerate. Both things can be true, and that's the kind of market that breaks people who trade with emotion. So here's the psychology shield in one simple checklist you can actually use. 1. Decide your time horizon before the next candle prints. Are you trading days, weeks, or months? 2. Size so that a nasty swing doesn't force you to act against your plan. If you can't hold through volatility, you don't own a thesis. You own a hope. 3. Define your invalidation line, not "I feel bad," a real structural line. For gold, think daily closes relative to the key support zone. For silver, think daily closes relative to the pivot and whether rebounds are immediate or sluggish. 4. Do not let social media change your plan mid-trade. The market will provide plenty of drama without help. 5. Treat spikes as risk, not as confirmation. In squeezes, spikes are where liquidity is worst and where you pay the highest price for being late. If you do those 5 things, you stop being the person who buys the top and sells the bottom in a market designed to trigger that behavior. And you become the person who can actually benefit from what this signal is saying. Now, the subtle CTA, because if you're watching this, you're not here for a bedtime story. You're here because you want the mechanics, the risk framing, and the next week checklist without the nonsense. If that asks your identity, if you rather be early and calm than loud and late, then stay in this community. Not for hype, for structure. Because the people who survive markets like this are the ones who learn to read what E's underneath the price. And right now, what's underneath the price is a coordinated message. Spreads and collateral are tightening the room, options are amplifying the tape, and the macro bid is pulling both metals with the same rope. Watch the curve, watch the closes, watch the pivots. And if you remember only one thing, remember this. When gold and silver move together, it is often the market telling you the dominant force isn't a headline. It is a constraint, and constraints don't negotiate politely. They break suddenly, or they release suddenly. Your job is to be positioned like a grown-up either way.